With the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
This week, returns in the stock market were brought to you by record-breaking AI, healthcare's hot streak, and a shutdown shrug, quite surprisingly. Our portfolios were up 4.5%, up 2.9%, and one was down 0.8%. We're going to talk about it all right now.
Welcome to the simple side. Market beating picks inside. There's no jargon and no time to waste. Join the simple side and end up in first place.
All right, some quick reminders like I do every week. Our full disclosure is in the email footer. Our portfolio for copy trading is available at the link at the top of the newsletter, again at thesimpleside.substack.com. You can find our podcast on YouTube, Spotify, Apple Music, and of course here on Substack. And you can get our daily market news updates from the Simple Side Daily newsletter, which you can find at thesimpleSideDaily.substack.com. As always, we also include our top and bottom positions in all our portfolios at the very top of the newsletter. Of course, we refer to these as trimmable positions and then positions that might be worth adding to in our portfolios that we still believe in. This week, I just want to tell you some of the stocks that exist in this trimmable positions bucket and then some of the stuff that exists in the positions to add to bucket, because these returns are just ridiculous in the portfolios. In our flagship fund, the top three stocks are Napco Security, Google, and Arista Networks, up 42%, 41%, and 23% year to date. Then in the AI secondhand effects portfolio, this is where it gets ridiculous. We have Centrus Energy up 360%, Bloom Energy up 271%, and SMR up 82%. And then in our tech growth portfolio, we've got Oklo up 110%, Hood up 49%, and Oscar up 47%. Just ridiculous returns there. The lowest, the lowest return that we have in any of our portfolios is in the secondhand effects portfolio with Equinox down 20%. The closest we have to that is negative 14 and negative 13%. So pretty impressive returns all across the board. As always, quickly talking about the portfolio performance from this past week. The tech-focused growth portfolio was up 2.6%. The AI secondhand effects portfolio was up 3.95%. And the flagship fund was up 0.64% as reported on Autopilot. Now remember, Autopilot seems to be looking 2 days in the rear. And so these returns show only the returns through Thursday, which means from Thursday to Friday, our tech-focused growth portfolio, I believe, jumped to 2.9% from 2.6%. The AI secondhand effects portfolio went from 3.95 up to 4.5%. And the flagship fund actually ended up dropping down from up 0.64% to down 0.8%. So overall, still an incredible week across the board. The S&P 500, of course, through Thursday was up 1.7%. So we outperformed on all fronts except for in that flagship fund, which is to be expected. We don't always expect the flagship fund or really any of the portfolios to be ahead of the S&P 100% of the time, but regardless. Now, like I said in the beginning, returns this week were brought to you by record-breaking AI, healthcare's hot streak, and a shutdown shrug. The S&P 500 and the Nasdaq notched fresh highs, even with Washington being closed for business. Big tech rode AI demand, hello Nvidia's $4.5 trillion market cap, and healthcare stocks were ripping on drug price headlines and fresh approvals. Of course, small caps did join the party. We did see energy lag as oil slipped into the low 60s. Now, usually when I talk about this stuff, I try to keep it pretty matter of fact when I do these weekly roundups. But I'm going to start inserting a little bit of my opinion as little quick segments underneath some of these different, paragraphs that I include when I'm going through and just giving you the daily news. I think it's valuable. You can not read these. You can skip over me talking about it if you just want to get the facts on the news. But I think it's important every once in a while to tell you how I look at what's happening in the market. This week, I think there's a lot of stuff that spells market top. Healthcare stocks seeing large amounts of capital flooding into them, not only because of drug price headlines and approvals coming in the biopharma side of things, but because it shows that investors are running to defensive sectors. And when I say investors, I'm not talking about retail. Of course, a lot of retail investors I refer to as dumb money, and it's never an insult, but it's just the fact that you're playing against a rigged system. And right now when the markets are ripping and everybody thinks that they're doing well, it's actually even worse because it gives people kind of this false sense of, I know what I'm doing. And that's what you're looking at right here. So healthcare seeing a bunch of money pour in usually means that either retail or big time traders are looking to get defensive. They're afraid the market's going to be dropping a little bit. And so I just did a little bit of digging and I jumped onto Robinhood, where they show kind of like their retail buying. So people on their platform, are they buying or selling out of stocks? And I pulled up Centene, ticker CNC, Molina Healthcare, ticker MOH, and UnitedHealth, ticker UNH stocks, just to look at the percentages of retail buying versus selling. And the difference is just astounding. So basically all of these companies are seeing large, heavy retail selling, but yet the stocks seem to all be climbing at a significant clip. And so what you're looking at is institutional money getting defensive. And I'm sure that if I went to go look at some of the more growth or small cap companies, you'd be seeing a lot of retail buying in those. And so what you're looking at is an institutional shift, a smart money shift from growth and tech into defensives, and retail, of course, going the opposite direction. And so the question you have to ask yourself is, who is right? And of course, I have my own opinions about that, but we'll save that for paying subscribers here in a little bit. Stocks, of course, were pushed to new peaks this week. Investors seem to be increasingly confident that the Federal Reserve rate cuts are in our future. Of course, yields on the 10-year treasuries hovered around 4.1% earlier in the week and then slipped late into the week. This, of course, tends to help growth stocks, which we saw in our portfolios. If you go up in the newsletter, again, thesimpleside.substack.com, and you look at our portfolio performance, you'll see that actually on Monday we were doing pretty well. Tuesday and Wednesday were down for us, and then Thursday ended up being a big jump for those two growth portfolios that we have. And again, big runs Thursday and Friday in both those companies. Oil, of course, was on the cheap side, great for traveling, great for shipping, but less great for energy company profits. Obviously, you can see how those two things are not correlated in the current market. They're a little uncorrelated. We saw energy kind of ripping, and no surprise there. Things like AI are just driving crazy demand for that kind of stuff. Gold, of course, stayed around its $3,900 range, which is definitely a sign that money is still buying insurance policies against geopolitical risks, even as stocks continue to climb. In tech, like I said before, Nvidia hitting that $4.5 trillion mark as demand for AI hardware and full stack systems is staying strong. Companies are starting to place big time orders for AI projects, and so the dollars are showing up in revenue for IT and chip suppliers. Again, we have yet to see AI create real revenue in businesses. AI, of course, is creating real revenue for energy companies and hardware companies, but not directly, kind of indirectly. They need the space for storage. They need the energy to run their data centers, but we haven't really seen AI be a revenue driver. OpenAI, famously the largest AI company that I guess most widely known, most used maybe. They're not turning a profit. They're a $500 billion company that is not making any money. And so we've yet to see this translate into real bottom line. And I suspect it's going to be a long time before we see that happen. It's going to be a long time. Energy is going to need to go way down. It's been ripping right now. And so we're going to need to see that drop. Again, I'm going to hit a little bit on healthcare here in the newsletter. I'm going to skip over it on the podcast, though, just because I already hit on it a few times. Autos are delivering mixed signals recently. Tesla posted record quarterly deliveries. buyers are rushing in to capture that soon to expire $7,500 EV incentive. And I think that has expired, but people are really looking to capture that, which is quite surprising. Ford and GM are using finance units to make leasing math attractive for buyers. In the near term, risk is that EV demand is going to cool without subsidies. I definitely think we're going to see that happen. And the auto industry, to me, seems like a very sketchy place to be right now, especially if you're an investor. Of course, the fight is for autonomous vehicles in the EV space specifically, and all of that, of course, becoming everyone's kind of quote-unquote target for success. Now, I think this is extremely bullish, but not for the companies that you think. I think it's bullish for Uber and Lyft. If everyone's going to be trying to rent out their autonomous cars, prices are going to be dropping big time, and the values for those cars aren't going to be as substantial as people think. But what this is going to create is a lot of excess demand, which is going to be harbored by Uber and Lyft. They're going to be the marketplaces, if you will, and they are going to be rewarded for being that marketplace. We saw a lot of good stuff with Boeing. They're saying that they're finding 10% more fuel efficient ways to build their aircrafts. BP is approving a $5 billion Deepwater Gulf project. And Total Energy sold half of their North American solar portfolio. But I don't really know how much of that I think is a big deal right now. Of course, pipeline deals for things like natural gas are becoming a big time deal. And I do think it is hilarious to see all of this happening now. I called all of this picks and shovels back in 2024. I was saying that you need to start buying the companies that are the shovels to the AI energy gold rush. And now, of course, we're seeing that same sentiment shared across tons of different news articles and corporations. And so people are finally starting to catch on. But of course, that coming after companies are running up 300, 500, 1,000% in return. So if you're following the news, you're behind. That's just the way that it works. As always, there are some insider trade updates here for you. I want to just quick cover the returns that we've seen from these insider buys. The average return is 8.56%. The average weekly return, 8.65%. And the average monthly return, 5.26%. So if you're looking to follow investor trades, if you make 5% a month, you're talking about just ridiculously outperforming the stock market every year. Now, if you're talking about 8.65% a week, then you're really talking about ridiculously outperforming the market. And so the only reason that we track these insider trades is because they are very, very valuable. We're not looking at any of the buys, we're not looking at any of the sells, only the buys. And so just presenting you stocks that might be worth taking a bit of a look at. We're not going to be saying I would invest in this or I wouldn't invest in this. And so this is just presenting data to you. Of course, we track all of this in our paid subscriber spreadsheet, so you can go and check that out if you're a paying subscriber. There, you'll find links to it all over in the newsletter. But that spreadsheet keeps track of every single one of the trades that we discuss on the newsletter and then presents all that data to you over there on the spreadsheet. So go through and read all that if you'd like. Now, one of the big things that I've started doing is presenting an interesting trade idea. Now, I never claim to invest any money into these. These are just trade ideas that I see out there that I think might be beneficial, or anybody who's looking to place some capital that doesn't want to put it in my portfolios, which I would recommend over any kind of just one-off trade. But I still want to tell you guys some interesting stuff that I've been seeing. And last week, we were talking about 4 different companies, and this week I'm talking about one. That company is Kenvue. The ticker is KVUE, and the company is down 40% since it spun off from Johnson & Johnson, I think back in 2023. The majority of this drop-off, though, is coming from a recent Tylenol to autism link, or at least a claim that it is linked. However, current analyst predictions call the company undervalued by how much? Around 36%. And I tend to agree with these projections. The company's been hit with these claims before, actually, believe it or not. Claims were made in 2023. Studies came out in 2024 supporting the claims. Lawsuits happened in 2023. The lawsuits were refuted. And recently, one of the main researchers, the one who published a study against Tylenol in 2024, said his subsequent analysis of everything shows the usage of Tylenol was not causal of autism. Was not causative of autism. He came out and said that the study that he co-authored in 2024 showed a quote-unquote small statistical association between acetaminophen, which is Tylenol, during the use of pregnancy and an increased risk of autism and ADHD. However, his subsequent analysis showed the link was not causal and likely a statistical artifact. So what you have is a company that is down 40% because the president or whoever decided to come out and say that Tylenol was causing autism. Then the researcher who puts together the study that they're referencing and saying this study proves it comes out and says, yeah, it's not true. We can't really make that correlation 100%. I did some more analysis and I was wrong. I mean, it's just crazy. The stock currently yields a 5.22% dividend. This outranks 82% of similar companies. And while the name Kenvue might not be known by a majority of consumers, the brands that sit below the line are some of the best in the business, some that everybody knows and buys. Listerine, Johnson's, Aveeno, Neutrogena, and Tylenol, of course, all of these are Kenvue brands. And the company is not out there trying to solve hard problems. It's just quietly managing some of the world's most well-known brands. I mean, you're talking about some of the most prominent brands that we see on shelves today. And I'm really hoping that we see some Kenvue shares show up on large prominent investors' 13F filings here in the coming months. Regardless, I think that there are some very intelligent ways to make some great money on the company, both in the short and long term. And I'm going to be writing an article. It should come out this next week talking about my investment into Kenvue and the strategy that I'm going to be playing over the next couple of weeks, months, however long it takes for the company to recover, to make some additional income for my portfolio. So be on the lookout for that if you're a paid subscriber. I'll send the email out to free subscribers too. I'll give you guys just a snippet at the top just to let you know what the article is going to be about generally. And then, of course, if you want to go paid and read the whole thesis, you can do that. But know that my money is invested in the company now. I'll be writing the thesis here in the coming week, but I do have money in the company now, so I do have some bias in what I'm writing there. Of course, you can go down below and see some of the Berkshire buy articles that I have written and how those stocks have performed. As a reference point, I think I've written 7 or 8 different articles so far. The average returns per article is 17.54%. And here are the returns. I'm just going to list them out. I'm not going to list the companies, but here are the returns just listed out. 19.61%, negative 3.4%, 62.31%, 46.57%, 0.92%, negative 3.96%, 19.16%, and negative 0.93%. So the top 3, 62, 45, and 19. The bottom 3, negative 0.9, negative 4, and negative 3. So pretty great performance on those bets there. Now, if you're listening to the podcast, you're going to get something a little extra special today. I'm going to talk about some stuff that I normally don't talk about. It's normally reserved just for the newsletter, just for paying subscribers. But if you're a free subscriber and you're listening, you're lucky. I'm going to give you a little bit of what the paid subscribers get. If you're a paid subscriber, keep listening. I'm going to just talk you through a little bit more of the newsletter. Before I do that, I just want to say thank you guys so much for getting me to over $900,000 in assets under management on autopilot. Based on the returns in the portfolios, that means that we've made investors over $100,000 in returns. And so that's really exciting for me just to know that everything that we're doing has been really profitable and valuable for all of you guys. Of course, all my personal money is invested in these portfolios, and so it's been, great for me as well. But I'm really glad to see that we've been able to turn a profit for all the subscribers as well. All right, we're going to jump down behind the paywall in the podcast. I'm going to skip over some of the portfolio holdings stuff, and I'm going to jump into just some cool stats. Real quick, if you're listening to the podcast as a free subscriber, I just want to tell you, we do a risk analysis and then an annualized return details on our flagship fund for all paying subscribers. And the flagship fund is kind of my main investment fund. I've been running it since 2020 when I was not even writing the newsletter yet. But our alpha, so basically the outperformance that we typically have against the market, is 16.65. Our beta, sort of like volatility, is 2.48. So we're quite a bit more volatile than the market, but outperforming by 16.65 is pretty impressive. Our Sharpe ratio, 1.3. Our Sorrentino ratio, 2.98. So pretty great numbers across the board there. Our strategy over the past month, which is the flagship fund, is 8.95% over the past 3 months, 13.98% over the past 6 months, 77.99%, and year-to-date 35.46%. Year-to-date, against the S&P 500, we're up over 20% more. Against the Nasdaq 100, we're up about 18% more. Against the Dow Jones average, we're up about 24% more, And against the Russell 2000 ETF, we're up about 23%. So we're outperforming everything by vast margins, and we're not doing anything crazy. At least I don't think it's too terrible crazy. I mean, you can go and copy trade this portfolio. Again, it's on autopilot, so go and do that. But since 2020 to now, that portfolio has, since 2020 to 2024, that portfolio has achieved 288% growth. So in 4 years, we did 288% returns. And of course, I think this is silly. A lot of people would be kind of, I guess, showing that off, showing it around everywhere, being like, look how great I am, pay for my newsletter. But the reality is that I'm reserving a lot of this for paying subscribers because, well, it is really impressive. I don't want to showcase that as something that I think is going to happen, something that's going to happen all the time. I don't want to have everybody thinking that over the next 4 years we're going to return another 288%. In fact, I think it's highly unlikely that we do that. So I'm somewhat skeptical of showing returns off in that way. I just don't want everybody to think that is what happens. But that's our returns right now over the past 4 years, including this year. We're probably up over 320-something%. So pretty impressive overall. All right, what I'm going to jump down to, though, is our portfolio strategies, updates, and new bets. So if you're a paid subscriber, scroll down to this in the newsletter, portfolio strategies, updates, and new bets, and I'm going to talk about some of the stuff that I mentioned here. So I've recently actually had a lot of people start to unsubscribe from the newsletter, saying that I'm not sending out enough content or making enough changes to the portfolio. And I just want to talk about this for a second. If you think that making outsized returns comes from investing in a ton of new stocks, making a ton of entries, making a ton of exits, that's wrong. It's violently wrong. Anyone who is telling you or says that they find a new undervalued stock every week and claims that their portfolio is making 50% returns every month or 50% returns every year, and they're doing it consistently, they're selling ideas to you, and they're not selling good investments. I love to say that there's a reason that CNBC isn't the richest company in the world, and it's that they aren't great investors or stock pickers. They're selling you ideas. They're selling you the news. I just want to remind you not to pay or buy ideas. Everyone has ideas, and most of them are worthless. I think Charlie Munger, Warren Buffett said that ideas are like, you get the point. Everybody has one. I would rather take one good idea once a year than one good idea once a year supplemented by 51 bad ideas for every other week. And so that's how this newsletter operates. That's how we found the AI energy bets that we made. That's how we do the tech-focused growth portfolio. That's how the flagship fund has done so well. We hardly make any adjustments there. In fact, we typically only make adjustments once a year. At the very beginning of the year, we set up that portfolio, and it's outperformed the way that it has. And so I really want to, pound this idea home that, you shouldn't be paying attention to people that are making ton of changes, because usually they don't know what they're doing and they're too emotional in the market. Now, getting back to the portfolios, I mentioned to paying subscribers a few weeks ago that I am looking for some potential hedges for my holdings in the coming weeks. This, of course, is going to sit alongside my cash position, which is kind of my main source of hedging. I'm not looking at trading options or the VIX, but I am looking at places that my money could go if inflation happens to pick back up and my cash starts to lose too much value. As I mentioned before, direct competitors to the US are going to make great positions. For example, China, other countries that are also not highly correlated with the US would make potentially great places to put my money. Sweden, Indonesia, Malaysia. But overall, I'm very risk adverse right now. I think the market is ripping, and I could make much more on my uninvested cash if I put it into the market, but I just don't know when things are going to crash. I can't predict that. And so that's why I keep a lot of my money out of the market. 50% of my cash is invested, and 50% of my cash is making 4%, now 3.75% after the rate cuts on the sideline. And I want to tell you about how the returns look when your investments are set up like that. So the flagship fund is up over 35% year to date. And that's 50% of my cash, and the other 50% is in a high yield savings account returning 4%. So my total return on cash is 35% times half plus 4% times half. And if you add that up, you get a 19.5% return. And remember, I'm not including the tech growth or the AI portfolios, which are up just vast amounts higher than this. So ignoring those, let's pretend that I guess we don't have to pretend, but the S&P 500 is up 14% year to date. So my average returns with half of my cash sitting on the sideline is still 5% higher, 5.5% higher than the SPY. So half of my cash is sitting on the sidelines, and I'm still doing 5% better than the SPY on a total cash return basis. So now let's pretend that the market drops 14%. The SPY now sits at 0% returns. And let's say this effect adversely hits my portfolio, and my portfolio drops 35%. I would still be beating the SPY. The SPY, of course, would be at 0% returns. My flagship fund would be at 0% returns, but half of my cash would still be making 4% returns in the stock market. Now, that 4% means that the 4% on my uninvested cash and the 0% return now on my invested cash means that my average portfolio return is now 2%. So I just want you to think about that. If the SPY dropped 14%, my portfolio dropped 35%, I would still be outperforming. And then I could take all the excess cash and dump it into my portfolios, which would then double the returns on the return run up that all of those companies would have over the next 5-10 years, whatever it would be. So that's how I think about this hedging right now. I'm still outperforming with the hedging. I would be outperforming with the hedging if the market crashes, and would be given an opportune time / position to put cash into the market and create excess returns over the long run. So that's just how I think about everything right now. That's how I'm positioned. I wanted to give you all kind of a glimpse into all that. And that is where I'm going to leave you for this week. I appreciate you so much for joining me. I'll be back next Saturday as always. And look for that article coming out this week on Kinview. And I will see you next weekend.